These considerations inherently limit the space for further reduction in policy rates.
The monetary policy announcement should help in investment revival and contribute to strengthening of business sentiments.
You would see a reduction in interest rates?
I think it's a good signal. Many more things have to happen in the course of the year, but I think it's a good way to start this.
Part of the challenge may have to be answered by price.
After 3 long years, the Reserve Bank of India finally cut rates last week. But will the joy be short-lived? Will we see interest rates coming down significantly? And what's the outlook going forward? Hello and welcome to We Mean Business. I'm Shweta Rajpal Kohli. On the show today, our big news maker, Dr. C. Rangarajan, the chairman of the Prime Minister's Economic Advisory Council and also a former RBI governor. Also joining me from Mumbai, Divakar Gupta, MD and CFO, State Bank of India, V. Vaidyanathan, VC and MD, Future Capital Holdings, Madan Sabnavis, Chief Economist of Care Ratings, Ashish Parthasarathy, Treasurer of HDFC Bank, Harsh Roongta, CEO of apnapesa.com, and of course with me here in studio, Dr. Surjit Bhalla, clearly doesn't need an introduction, Chairman, Oxis Investments. Thank you all gentlemen for being with us here on the show. But before we move on, a quick look at the 5 big questions we will be asking on the show today. Will there be no more rate cuts in 2012? Are we going to see loans, specifically home loans, getting cheaper? After the big rate cut, are banks reluctant to pass it on to consumers? Are high interest rates really hurting growth? And will the big rate cut revive sentiment? Those are the 5 big questions we will be asking on the show. But first, a quick look at the developments that have taken place over the last 10 days.
A big bang announcement by the RBI to cut rates for the first time after 3 years. Markets and industry saw this move as one that would reverse the rate cycle. But that hope, with a tinge of joy, was short-lived.
Both the probability of a rate reduction and the probability of a rate hike are non-zero, but small. Okay? And we will have to calibrate the policy as we go along.
The opinion among bankers was divided. While several banks seeing weak demand for loans cut base rates by up to 25 basis points, the others chose to tread cautiously, not taking a cue from the RBI.
In terms of the base rates, again, we will see what some of the larger competitors do, and if competition is reducing it, I guess we will. But as of now, we don't feel the compulsion to do it.
Experts believe that by the end of next quarter, almost all the banks would have cut their rates. But unless the deposit rates come down first, bankers don't expect any significant cut in their lending rates.
I don't think the liquidity levels in the market today warrant any significant adjustment in rates. So at best, we will do like what some of the others have done, 25 basis points here and there, and not immediately so.
The cut in repo rate is seen as a good beginning, but a section of the market has called the RBI move a gamble rather than a growth booster. With the demon of inflation still not completely in control, skeptics are wondering if rate cuts will yield the desired results.
This move by the RBI clearly indicates that slowing growth has become a bigger worry than high inflation. But with the governor spelling out a word of caution, this shift in priorities from controlling inflation to lifting growth might just be short-lived. In Mumbai, Astha Maheshwari, NDTV Profit.
Well, let me go straight across to our big newsmaker of the day, Dr. C. Rangarajan, Chairman of the Prime Minister's Economic Advisory Council, joining us now. Dr. Rangarajan, thanks so much for being with us here on NDTV. We saw the Reserve Bank of India cut rates last week, the quantum much higher than what everybody had expected. But it also came with a warning from the governor. Don't expect any more. So can we safely say it was the first and the last rate cut of this year?
The Reserve Bank of India was pulled by two sets of opposing factors or considerations. On the one hand, the growth has been slowing down. The industrial production particularly was weaker than was expected. On the other side, the inflation continued to remain at a high level. The only redeeming feature was that the non-food manufacturing inflation has come below 5% as compared to 8% in November 2011. So taking both these factors into account, the Reserve Bank of India decided in the direction of easing the policy a little bit by reducing the policy rate by 50 basis points. But it must also be understood that the Reserve Bank of India has added a rider, and they have said that as part of the guidelines that further reductions in the policy rate are going to be difficult. According to them, the space for that is very limited. Therefore, going ahead, I think the policy of the Reserve Bank of India will be determined by the behavior of inflation. On the one hand, they have given some fillip to growth by reducing the interest rate, the policy rate, but we should not assume that further reductions are automatic.
That's right, further reductions are not automatic. We will have to wait before inflation tapers off further, and only then will we see any rate cuts. But Dr. Rangarajan, some banks have followed it up by cutting deposit rates. Some have cut lending rates as well. But most bankers say they're just not convinced that there's enough room to actually pass on that rate cut to consumers. The centre is almost having to dictate to public sector banks that they don't have an option. They have to go ahead and cut rates.
Well, the whole idea of signaling a change in the policy rate is to enable the banks to follow it. After all, changing the policy rate by itself does not do anything because that only means that the rate at which they will borrow from the central bank of the country will be higher or lower depending upon in which direction the policy rate has been changed. Normally, it is expected then the policy rate is changed. Simultaneously, the banks will also act. But the extent to which they will act will depend upon the strengths of the individual banks. But the signal is there, and perhaps the liquidity situation will also be eased by the central bank to the extent necessary in order to make the policy change stick. Therefore, you should expect the individual commercial banks to respond to it in the same direction, but the extent to which they will expand, they will respond, will depend upon the liability asset structure, the composition of the deposits of that particular bank.
Dr. Rangarajan, at what level of inflation would you recommend a further rate cut, if at all, coming from the Reserve Bank?
Well, for the time being, the policy to follow should be to pass at this stage. A certain reduction has already been announced and let it take its effect. But unless the falls closer to somewhere between 6 and 6.5% on its own, then that may be the time at which some further changes may be thought of. But that we don't know when it will happen. Therefore, until such time as a definite signs of decline is seen in the inflation rate, I will not personally recommend any change in policy.
And there are, of course, fears, Dr. Rangarajan, that inflation will come back quickly. Crude prices continue to be a big worry. So your outlook for inflation as well as interest rates going forward for this year?
Well, as I mentioned that the changes in the administered prices would also push the inflation up. Therefore, leaving out the impact of any change in the administered prices, if the inflation rate falls around 6%, then that is a time at which one can really think in terms of some policy change. But I think that inflation rate could come around below 6.5% or around 6.5% during the course of the year, perhaps by December of the current year.
Dr. Rangarajan, digressing from the issue of rates specifically to talk about the larger macroeconomic situation. Yesterday we had Standard & Poor's cut India's outlook to negative. Do you really see that as a wake-up call for policymakers? Would you agree with the assessment of the rating agency?
This is one perception. I think the rating agency has looked at some of the features of the Indian economy, and they have come to a certain conclusion. Some of the facts that they have brought out are well known. We do know that growth has slowed down. The current account deficit is remaining at a high level, as well as the fiscal deficit is large. But looking ahead, one should look at what will happen in the current fiscal year. I believe that it is still possible to achieve a growth rate between 7 and 7.5% this fiscal. While the current account deficit was somewhat large last year because of the gold imports, it may also come down. And if you look at the current account deficit, excluding gold, it is at a very reasonable level. Therefore, as inflation comes down, perhaps the attraction of gold as a hedge against inflation may come down, and therefore I expect the current account deficit to improve. I am not pessimistic as the rating agency. I do believe that the Indian economy will do better during the current year.
But Dr. Rangarajan, there's no denying that there's complete inaction on part of the government despite pressure from all quarters, including the RBI, to contain the fiscal deficit. Just look at the subsidy bill, for instance. The government isn't even allowing a petrol price hike, leave alone deregulating diesel at this point in time.
Well, as far as the fiscal deficit is concerned, you must wait and see. I think repeatedly it has been stated by the finance minister himself that we will ensure that the subsidies, for example, would be contained at 2% of the GDP. Wait for some time, and perhaps you will see the action coming. Therefore, there is a definite assurance that has been given by the government that the fiscal deficit this year would be contained at the budgeted level. There is the need to find the appropriate time to do it. Perhaps the time we were thinking was such that the inflation rate is coming down more sharply. If the inflation rate had fallen a little more than what had happened in March, perhaps it would have been easier to do it, because we all know that any adjustment in the administered prices relating to diesel or any other commodity would have the immediate effect of pushing up the price level. The index will go up. Therefore, the correct time to do it is at a time when the index otherwise would be showing somewhat of a sharper decline.
But what we're seeing happen right now, Dr. Rangarajan, is a lot of growing stress between Mint Street and North Block. Do you feel that monetary and fiscal policy decisions aren't really moving in tandem? The RBI is being forced to take action because things just aren't moving in Delhi.
The Reserve Bank of India has, not only now, but even in the past, has drawn attention to what the fisc must do, particularly at a time when inflation is running high. Therefore, it is not something very unusual. The Monetary Authority always draws attention to the need for containing the fiscal deficit whenever demand pressures in the system are very high. Therefore, I do not see this as a tension which is unproductive. I mean, I think this is a tension that will remain because the primary concern of the central bank is price stability, and therefore when demand pressures rise, it has to give out a signal and it has to provide a warning, and therefore the fisc also must respond to it. And I think the budget has been framed with a view to bring down the fiscal deficit. Otherwise, the finance minister would not have shown that the fiscal deficit will come down from 5.8% to 5.1%. Therefore, the tension that you talk about is what I would call a creative tension.
But Dr. Rangarajan, politics has to also support the economic agenda, and right now what we are seeing is a very, very difficult political situation. Never in the recent past have we seen such criticism of India's economic policies. Everyone is questioning why our economist Prime Minister just isn't able to deliver. Your thoughts, given that you're the advisor to the Prime Minister?
I think if you look at the growth record, you find a decline in the growth rate, which is below 7% only last year. After all, we recovered very quickly from the impact of the international financial crisis. The year after the crisis, we grew at 8%, the following year at 8.4%. I think the real lesson for us is really to get back to the higher level of growth. Certainly, some of the factors that you pointed out are correct, in the sense that there is a difficult political situation. But I think the Prime Minister and the government must be able to assert themselves during the current year, and they perhaps will. And we should get back to a higher trajectory of economic growth. And I think the only way in which to re-inject optimism and a greater faith in the economy is by growing faster in the current fiscal year. If we can get back to a growth rate of 7 to 7.7, particularly 7.5% in the current fiscal, much of the gloom that we are talking about now will vanish.
All right, Dr. Rangarajan, many, many thanks for joining us and sharing your views. It's always such a pleasure to talk to you. And let me go straight across to the panel now and ask those 5 big questions that we're trying to answer on the show. The first question, are we going to see no more rate cuts in 2012? Is the Big Bang rate cut happened? Was it the first and the last for the year? Let me go straight across to Mr. V. Vaidyanathan and try and get some sense of that question. Do you think we're done with rate cuts? The RBI governor is saying limited room. He's almost indicating there is no more room.
Well, yeah, we heard that comment called limited room. But I think it's really too early to call that there will be no more rate cuts for the rest of the year, because the rest of the year is still a long time to go. And the other part is that we have often felt and believed and heard that inflation is RBI's problem and the growth is the government's problem. But that's not as much true, because growth is as much the RBI's problem, and that's coming through really very clearly. And I think even in the rest of the year, if growth continues to flag, then RBI may come back and cut more rates. I do feel like that. But
all right, Dr. Bhalla.
But of course, having said that, I must say that the RBI will be watching the government's actions really very closely. And if they continue to see, so to say, paralysis in action, then I think they will be worried. But if they see the government moving and taking specific action, specifically on oil, specifically on other subsidies like fertilizer, etc., then they can be equally emboldened that they can play their hand a little more strongly in the rest of the year as well.
Dr. Bhalla, inaction in Delhi, the RBI being forced to act, which is why we saw a larger than expected rate cut coming from the Reserve Bank. But going forward, the window may be really limited, because you know that inflation will crop up once again as the biggest worry for the Reserve Bank.
Look, I may belong to a minority camp, but I think half the problem is the RBI. We keep saying that all the problem is in Delhi, and we are surrounded by policy paralysis of a kind that I've never seen before in any economy. Right. But let's look at what the RBI has done and what has stated. Throughout last year, when, if you will, the economy was in real trouble, and the growth rate for last year, that 2011-12, will be lower than the great financial crisis growth year of 2008-9, and the RBI was busy hiking rates.
Right,
okay.
Right.
So therefore, when we look at the fiscal deficit, which came out at 5.8, 5.9, about 1.2 percentage points higher than what was budgeted, about half of that is clearly due to the slower growth. And that is entirely the responsibility of the RBI.
It's a vicious cycle, but at the same time,
it's not a vicious cycle.
Dr. Bhalla, you cannot expect a Reserve Bank to actually cut rates when inflation is at such high levels. So the RBI had to respond.
Thank you for asking me the question. The inflation was continuously falling. The inflation doesn't fall in 1 month. It was continuously falling all year. But the RBI was too preoccupied, including you journalists, with year-on-year inflation rates, which are still our policymakers are too preoccupied with. And if you will, there were several times on this show, on other shows, etc., that I documented and other people documented that seasonally adjusted annualized rates, which is what the rest of the world was with, were collapsing.
And we shouldn't have gone in for the kind of hikes
and if you will, the Technical Advisory Committee of the RBI, which is 6 experts, not me, 6 experts, they recommended that throughout the entire year, the maximum rate hike should have been was about 45 basis points, and the RBI did 150. So the point is, I'm not alone in attributing a large part of the decline in India's growth rate and therefore the increase in the deficit to the doors of the RBI. Now, then the RBI cuts rates and comes out with this statement that there may not be any more rate cuts. Let me just remind you and our viewers as to what the RBI has done over the last year. First, they said, if our memory serves me right, that we want inflation to be down to 7%, WPI inflation, by March. Okay. Then, as soon as the WPI came, was looking like it had already fallen below that level on seasonally adjusted basis, they said, oh, we are looking at something else. We are looking at manufactured, non-food inflation.
To come down. And
that
inflation still remains so high.
And inflation still remains too high. That has come down to the lowest level in 3 years now. Third, they said, we will look at the fiscal deficit. They're changing the goalposts all the time, and the goalposts are being met, and the RBI keeps scoring own goals.
All right, is the RBI changing its goalposts, and is the Reserve Bank's policy, the baby steps that we're talking about, really responsible for the slowdown in growth? Let me actually ask Madan Sabnavis that question. Enough criticism of the RBI's baby steps policy, the hikes that we had seen, 13 hikes since March 2010. Your quick thoughts on whether the RBI on its own is responsible for that slowdown in growth that it's now trying to correct by reversing the policy stance?
I think we are slightly dramatizing the whole issue by saying that it's interest rates which have held back growth in the country. We should remember that where does growth actually emanate from? If you look at your elementary economics books, it says it's consumption, it's investment, it's government expenditure, and it's exports. Now, consumption has been down because we've had high inflation. So therefore, I feel, contrary to what Dr. Bhalla has been saying, that the RBI's move to increase interest rates was a step in the right direction. Because as long as I have high inflation, I will not be able to, I'll be spending more money on my regular consumption, which has affected savings and later on investment. Second, if you look at investment, yes, definitely investment has been retarded, because today the only entity which is able to borrow at competitive rates is the government. And the government itself has been in all kinds of problems in terms of its fiscal deficit. And in order to make sure that the fiscal deficit is under control, what the government has been doing is cutting back on its own investment or project expenditure. And then we have seen that the exports is one element which has shown remarkable growth last year, but we are not an export-oriented economy. So therefore, what I would like to say here is that growth has actually been held up more on the demand side rather than interest rates. Yeah, definitely having lower interest rates would have helped, but being a monetary authority, I don't think a central bank can sit back and say that if I have an average inflation rate close to 10%, in fact, quite ironically, after the RBI did lower interest rates by 50 basis points last week, we get a CPI number of close to 10%.
very high consumer inflation.
No, we had on the basis of inflation, we just had the CPI number showing it's 9.5%. So in fact, I feel that even lowering this interest rate by 50 basis points is slightly confusing, because for 2 years we've been attacking inflation. We've been saying that monetary policy.
What you're saying, Madan, is that the 50 basis point rate cut shouldn't have actually happened. It was too early and too much. Are you saying it's too early and too much?
Yeah, it's too early and too much. I actually won't say it's too early and too much. Too early, definitely, but too much, I'm not quite sure, because in case we had a 25 basis points decrease, it wouldn't have helped at all. It had to be significant. So therefore, the RBI can be credited by saying that if at all I'm going to do it, let me do it by 50 basis points so it has an impact. Because I'm sure if you had 25 basis points, all of us here would have said 25 basis points is too meek. It's not really going to matter. So let's say that growth has actually been down not because of only interest rates. There have been other factors on the demand side which has retarded growth. And RBI probably has played a good role in increasing interest rates, because with high inflation, I don't think the economy would have really carried on. Because just to draw one last point, if you look at corporate performance, it's one thing to say that interest rates have come in the way of the profit, but look at the raw material costs. The input costs have gone up substantially, and that's only because of inflation.
Right, let me get a banker's perspective. Divakar Gupta, MD and CFO of State Bank of India. What we are debating here really is the high rate interest scenario largely responsible for the slowdown in growth? Are we saying the policy paralysis, no movement on the fiscal side is the bigger worry, or is it that we're seeing high interest rates that actually led to the slowdown in growth? Your quick perspective on that debate that's really taking place. The industry time and again saying lower interest rates and growth will improve. Would you agree?
No, I think rising input costs as well as falling demand is what has put industry in trouble. Now, there is no doubt that interest rates are a component of costs, but I would certainly not believe that they are the only factor, or that if they had not been raised, everything would be well. The problem with guessing in hindsight is always that we never know what would have happened if another course of action had been taken. So I would think Reserve Bank has been quite responsible and reasonable in doing what it did, and knowing that there are so many headwinds going forward, they have clutched at the small window that was available to them and done more than they could on the cut. And as Dr. Rangarajan was saying, I think we will hope that things will improve. It's happened in the past. There is no reason to believe that there won't be further rate cuts, but yes, we do need the environment to improve.
All right. So what we are seeing here really is two divided views. Dr. Bhalla obviously not agreeing with the way the Reserve Bank has gone ahead, but you've got enough bankers saying that the Reserve Bank has played a responsible role. A very, very important point that has been raised there by Mr. Divakar Gupta. It's very easy to say in hindsight to look back and criticize the policy, but another big question that we will be asking after a quick break is that will that big rate cut actually help revive sentiment? Let's look forward and see what that rate cut really means. That discussion coming up after a quick break. Don't go away.
These considerations inherently limit the space for further reduction in policy rates.
The monetary policy announcement should help in investment revival and contribute to strengthening of business sentiments.
You would see a reduction in interest rates?
I think it's a good signal. Many more things have to happen in the course of the year, but I think it's a good way to start this.
Part of the challenge may have to be answered by price.
Welcome back. You're with We Mean Business, and the question that we're asking, will RBI's big rate cut help revive sentiment? Ashish Parthasarthi, your views on the fact that it's time now that we start being forward-looking. We want answers as to whether this big rate cut, bigger than what most people had expected, will actually be a game changer for the economy. Will it really help improve sentiment?
See, in my view, interest rate environment creates, I think, an enabling environment for growth or otherwise. You know, when I think inflation was high, RBI was increasing rates. I think one of the objectives was to slow down growth to a level where inflation can either stabilize and stop rising further. Today they have cut rates because they believe that the growth has fallen below what the trend growth rate of the economy is, and they're trying to create an environment which is enabling, which will possibly enable growth. But that can't be the only factor which will revive sentiment. I think any investor would like to look at what returns they can get over their investments, over the investment horizon, and interest rates is just one of the factors. If the other factors are not in place, I think this won't be good enough.
Not good enough, clearly, to change the sentiment. So in that sense, has this really been a gamble on part of the RBI? The main aim, of course, has been twofold. One, to revive sentiment, to improve growth. The other also is to actually bring about a reduction in overall interest rates. And that's where I want to bring in the SBI view. Mr. Divakar Gupta, why this reluctance on part of the banks to pass on this rate cut? We thought what we've got is actually higher than expected. So why are banks really reluctant to bring down lending rates right now?
No, banks earn on advances and pay out on deposits. The repo rate is a signal rate. It shows sentiment. It shows a direction that Reserve Bank would ideally like to see banks take. But banks have to act on the basis of their balance sheets. I think the cuts that have happened so far, therefore, are not bad, because the cuts have actually eaten into the bank's bottom line, with hope that in future deposit rates will fall and therefore banks will be able to make up. Now, if you look at State Bank itself, we have actually cut deposit rates as well, because sustainability of a reduction in rates has to come from a saving in the interest paid out. So I think it's very early. We shouldn't be expecting a lot of movement within 10 days of the RBI announcement, but directionally all banks are trending down, and it augurs well for rates to come down. Liquidity is comfortable.
Sense of the kind of rate cuts that we will see, the timing, give us an outlook for rate cuts here on. Are you saying that wait and we will see that reduction coming in? I will be going to Mr. Harsh Roongta, because he actually has a pulse of the consumers who are waiting to see their home loan rates come down.
No, I would think as time passes, if liquidity doesn't get bad, we would see rates coming down. Deposits rates will trend down, and certainly banks will pass on the benefit. The CRR cut has helped as well, and that has helped banks to do an upfront cut.
Mr. Roongta, there's always a lot of hope among consumers, home loan borrowers who are always waiting for that big rate cut announcement. And what we often see them asking is, whenever there's a rate hike by the RBI and we see the adjustments taking place on part of the banks, they quickly send you a letter and increase your interest rate on your home loan. But we never see that really happen when it comes to rate cuts, and there's always a lag between an RBI rate cut and when we actually see lending rates coming down. What's the sense within consumers right now? Are they anxious? Are they waiting for home loans to come down significantly?
Well, yes, I think as far as consumers are concerned, Shweta, I mean, one can't fault the arguments that we are having in this forum that unless deposit rates come down, lending rates can't come down as well. The only reason why it doesn't sound as convincing to a consumer on the street is that the same argument is not used when rates are going up. So I think that really, these are chickens that are coming home to roost. Obviously, even when policy signals go up, it's a while before the deposit rates will go up. So there should be a lag when base rates are raised. Now that has not happened, and because of that, now obviously consumers have a fairly justified expectation that the rate should fall. Some rates have fallen. Hopefully, we will see more fall in the future.
Yeah, Mr. Parthasarathi, you wanted to say something. Please go ahead.
Yeah, I would like to add something to this. See, when the rates were going up, the liquidity was also very tight. So the transmission of policy was very effective. Today, what we see is rates, the signaling rate has come, but the liquidity has not eased enough. If you see, we ended up the last financial year with a CD ratio of over 76%. Going by the RBI's projections of credit and deposit growth, by that logic, the CD ratio would actually increase and maybe go close to 78%. So in that sense, if liquidity doesn't improve, the growth rate is as what is projected, it's very unlikely that deposit rates are going to come down significantly. The only way deposit rates can come down significantly is if liquidity eases significantly from what it is today. And only when that happens, you could see significant downside to lending rates.
In fact, today I think when you're looking at deposits, Shweta, can I just have a point out here? Because if you realize what happened last year was there was a slowdown in the growth in deposits, notwithstanding the fact that interest rates went up.
Right.
Now, we have a situation where your small savings rates have been enhanced. They are much higher than what they were earlier. And now in case banks are going to start lowering their deposit rates, you'll run into a problem where those who normally traditionally go in for bank deposits would prefer to shift their funds to small savings. So I think it would be a bit too premature for banks to start lowering deposit rates right now.
Isn't there a limit on how much you can put into small savings? So is small savings that much of a constraint on what you do with deposit rates?
Mr. Savnafis, would you like to answer that?
Sorry, I didn't think I heard that.
Yeah, no, basically, I thought that there's a constraint on how much an individual can put into small savings deposits. So in the olden days, 10 years ago, the small savings were a big, if you will, competitor to deposit rates. Now it is not much of a competitor, so what happens to small savings rates does not really affect or should not really affect that much what happens to deposit rates.
But this may probably hold for people like us where we probably have exceeded that limit which we can put. But if you're talking of people in the lower and middle income brackets, definitely they would have a better choice here and may probably exercise it. It's just a possibility. I'm not saying it's going to happen, but banks have to keep that in mind, because we have seen in the past also when mutual funds were attractive, funds were moved towards mutual funds and away from bank deposits. The same thing with small savings. It's just a possibility. I'm not saying it's going to happen, but it's very likely that it could happen.
Shweta, I feel that one of the significant things is the liquidity. And we should not rule out the possibility of even another CRR cut, maybe another 25 or 50 basis points to infuse the kind of liquidity that is required. And because there is a structural issue on liquidity, and once that is done, I think the transmission of interest rates on the downward side would be even more effective.
Shweta, just a point to go back.
All right, yeah, Mr. Roongta, you had a point to make. Go ahead.
Yeah, absolutely. To what Mr. Parthasarthi say, sure, and there is an issue. I mean, lending deposit rates will not go down as fast. It's also what communication the banks have used in the past when the rates went up. I mean, what was the communication on the street to the lay consumer? The communication on the street to the lay consumer was RBI has raised rates and hence these rates rise because RBI has raised rates. In fact, if you do a poll from the consumers, they think that when RBI drops rates, their rates should drop automatically, and that when RBI increases rates, their rates will increase. And I think the problem is also in the way it has been communicated, because that was convenient at that time. For the banks, it was very convenient to point to RBI to say why their home loan rates are going up. Now, of course, when they are going down and there are genuine, valid reasons.
I should get you to respond to that charge being made by Mr. Roongta, because it is true. It's very convenient to use the RBI rate hike as a tool to tell consumers that's the reason why your rates are going up. And what's the argument when it's not passed on in case of a rate cut?
No, I think the truth lies
to your consumers.
We have never communicated that rates are going up because RBI has raised rates. If you look at the history of 13 rate rises, State Bank hasn't raised rates 13 times. And the last 2 times that the RBI raised its rate, we did not raise the base rate. So I don't think it is really true that all banks raise rates all the time when RBI announces a raise. But yes, there is no one-to-one correspondence. So there could be mismatch, and there could be this perception in the minds of the public. I guess we need to communicate better, but really the point at issue is that there is not a one-to-one correspondence between the Reserve Bank changing its reference rate and the banks actually finding that true on their balance sheets in the short term.
All right, we're going to carry forward that discussion after a quick break, and also coming up after a break, we're going to ask, is there a new normal for inflation? Does the Reserve Bank have a higher tolerance level for inflation? And also some questions coming up from our viewers. That's after a quick break. Don't go away. Welcome back. Here with We Mean Business, and the big issue we're discussing today is the RBI's rate cut, and has it been a great gamble? Also, will inflation be back to haunt us as well as the Reserve Bank, and is there a new tolerance level, a new normal for inflation? Dr. Bhalla, seeing the RBI cut rates at a time when inflation still remains high, and as we also had one of the panelists talking about the high consumer inflation number that came just the day after the RBI rate cut, are we seeing that the central bank now has a new tolerance level for inflation?
There are several questions involved with there, and several, if I may say so, misperceptions. The new consumer price index that came out the day after, which showed 8.8%, is way out of line with every other inflation index that we have in India.
Right.
Okay,
Right.
and it is about
So it's not a correct measure.
It's about 2.5 percentage points higher than any other inflation measure, including the old CPI, agricultural labours, the old CPIW. So therefore, let's table that for the moment.
Sure.
Because this thing is something that is not
But
seen.
the overall WPI is
Now,
also very high.
Therefore, now I come back to your earlier. It's not very high. It's 6.9%, if you will, which is below the target, which is the lowest in the last 3 years. There's nobody questioning that we have had high inflation over the last 3-4 years. There's nobody questioning that we've had policy paralysis over the last 3-4 years. What I'm saying is, precisely because of the policy paralysis, we have got a very low growth situation, and if you will, because of the low growth situation, we have a low inflation scenario now going forward. So therefore, it was not a gamble at all.
Low inflation scenario?
Yes. Look, I don't know which index you want me to take.
Okay.
The RBI says we are going to look at manufactured non-food inflation. That came out below 5%. Now, what inflation do you want? Zero? Negative?
All right.
Why don't you
All
set
right.
a benchmark
Mr.
that we can
Vaidyanathan,
all subscribe to?
Mr. Vaidyanathan, Dr. Balla here arguing clearly in favor of more rate cuts, saying that inflation is not such a worry. But going forward, aren't there fears that inflation will come back to haunt us and the RBI has to continue to keep a close eye on the inflation number?
Well, you can't argue with the statement of keeping a close eye. But let me just say that while there are suppressed inflation issues like oil and so on, as and when they get passed on, yes, there is a risk that inflation will increase. But at the same time, the RBI has to get on with the task of reviving growth, because should not really take growth for granted. For too long, we have talked about, when we talk of India, we say, look, anyway we will grow at 7. What's wrong with 7? Other countries are growing at 2 or 3. We are fine. But this complacency is what has taken us to 6.1. I don't think we should take that for granted. Of course, we should be concerned about inflation, no doubt. But at the same time, if we keep our eye only on one ball, I think we may be missing the bigger picture. One important thing for us to remember is this, that whenever we talk in India, we think that high growth equal to high inflation, and then the only way to address this is lower inflation. But look at China. They've grown at 10% per year for 30 years, and their inflation is always 4% or 6%. When they touch 6%, they call it high. So really, for 30 years, if we can grow at 10% and keep inflation there, there's a message in that story that if supply side measures are introduced at the right times, if supply grows, if reforms stay on path, then actually we can keep inflation low and growth high. And we could very easily slip over to the other combination of high inflation and low growth if we don't watch this equation very carefully. I'm sure RBI must be concerned about these issues and will tackle that.
Right, we actually have a lot of questions from viewers also lined up. Let me go across to the first question. Let's try and play that for you and take some answers to those questions.
And I have a question for Ashish. Now, going forward, there is a lot of speculation in the market on that there will be certain more rate cuts expected for home loans. Now, going forward, first, should we wait for the further cuts to happen? If yes, then should we go in for a fixed rate or should we go in for a floating rate?
That question specifically coming in for Ashish Parthasarathy. Ashish, would you like to take that question?
Yeah, see, our view is that yes, there would be further rate cuts by RBI during this financial year, and the lending rates will come down. But it will take some time for the lending rates to come down, and we expect possibly another 50 basis point downward movement in lending rates sometime during the course of the financial year. On the question of whether it should be fixed rate or floating rate, I think if we see over the period of the loan, I think if it's a longer term loan, I think prefer consumers to take floating rate loans, because I think over a period of a long period of 15 to 20 years it will even out. But if we are looking at short time frames, taking a loan for a longer period but wanting to repay within say a 2 or 3 year period, at this point in time I think after rates come down I would advocate a fixed rate loan and not a floating rate loan.
Mr. Roongta, if you could quickly add to that, would you also say that a floating rate is better at this point in time than a fixed rate, given that fixed rates are very, very high, and also that yes, we may see lending rates come down a bit over the next couple of months. So if you're looking at that 50 basis points making a difference to you, perhaps best to wait.
Quickly, Shweta, before I answer that, the other question he said, should I wait for the rates to fall? I've never understood this question. I mean, you're going to get into a floating rate, and we'll talk quickly why. If you're going to get into a floating rate, get in now if you can get the loan that you are eligible for. Your rate will fall. You just keep an eye on it to make sure that the bank passes it on to you. And if they do that, what does it matter whether you buy it now or whether you buy it 6 months down the line? You will get the reduction in rates. As far as floating and fixed is concerned, I mean, how does fixed make sense today? I mean, we are probably at the, not probably, we clearly are going to see decline in rates. I mean, nobody is talking of increase in rates. Why would you want to lock into a fixed rate? Having said that, this is not a one-time decision. I mean, 6 months, as they say, is a long time. So just review this. But as of today, we can't even talk fixed rates. I mean, how does it make any kind of sense?
All right. Before I get closing comments, let's take 2 more questions very quickly. The next question also on interest rates. Let's quickly play that.
I've been waiting for almost a year now to take the loan, and now the rates have come down. Is it the right time to take the loan, apply for the loans?
I think Mr. Roongta has already answered that question on when is it the right time to take the loan. If you're eligible for one, go ahead and take that. But Mr. Divakar Gupta,
the right time to take a loan, the right time to take a home loan, for example, is when you want to buy a home. I mean, a loan is a means to an end, right? So, I mean, real question is, should I buy my home now or not? And I think the interest is important, but it can't be the only factor to decide whether you should buy your home or not. And if it is for your own residence, if you made a commitment to a city and you have the budget, please buy it now. Don't try to time a home purchase for own residence. It just doesn't make sense.
But Mr. Gupta, if I could ask you, because there are enough people who say that why should you go in for a home loan at the peak of the cycle, and there is hope now that of course we will see home loans get cheaper here on. Your advice to prospective home buyers, if they can wait for another 6 months before they take a home loan, is it best to wait? If you're looking at people looking at perhaps SBI to take a loan, would you tell them wait for a bit, we might cut home loan rates?
No, I would say go for floating and go in today. We very transparently reduce rates on all loans, and if it's a floating rate loan, it doesn't matter whether you take it now or 6 months later.
Okay, clearly running out of time, but one quick question before we take closing comments.
With respect to the recent government rate cuts, RBI rate cuts, how is the government planning to curb a strike between the GDP growth, inflation and monetary policy?
Madan Sabnavis, if you could answer that question, and in fact it's a question that just about every policy maker is always trying to answer, the entire balance between growth and inflation, will it get even tougher here on in 2012? And we will perhaps end the show on that note.
No, I have a feeling that the fact that the RBI has decreased interest rates by 50 basis points last week, coupled with the fact that our basic standard for inflation has now changed from 4 to 5%, which it had earlier, now to 6.5%. It basically means that we feel that there's very little that we can do about inflation today. We're fairly helpless, and therefore let's look at growth now. Now, this 50 basis points decrease in interest rates is a signal to the banks that you should lower interest rates, and probably people are going to borrow more money, industry is going to borrow more money. But the fact that the RBI has also stated in the same lens saying that don't expect any more interest rate cuts is not very encouraging in terms of the future path of interest rates. So as of now, it looks as if the RBI has said that it can't do too much on inflation. It's going to keep watching inflation and hope that if inflation does come down, it could go further ahead and lower interest rates. But as of now, the RBI would probably gamble more on growth rather than on inflation.
Okay, I'm going to actually take a quick poll on the 5 questions we've been asking, and I hope that I'll get a yes or no answer, even though it depends on various factors. No more rate cuts in 2012. A quick yes or no answer from everybody. I'll start with Dr. Bhalla.
I think you'll be shocked as to how much inflation falls this year, and therefore interest rates will fall about 150 basis points going forward.
Mr. Divakar Gupta?
We will. I am quite hopeful we will.
Madan Sabnavis?
50 basis points cut in the second half of the year.
All right, Ashish Parthasarathy, your views?
50 basis points during this year, some of it front-loaded.
Mr. Vaidyanathan?
Certainly a rate cut, maybe front-loaded, but certainly a rate cut, depending a lot on government action, will get confidence for the RBI, but I would expect it.
Harsh Roongta, your thoughts? Are we going to see another rate cut in this year?
In respect of the consumer, very unlikely.
For the consumers, very unlikely. All right. We've clearly run out of time on this show. I wish we could actually answer all the other questions, also take closing comments on the other questions, but unfortunately we've run out of time on this show. But remember, on We Mean Business, we will continue to answer all those policy questions, and as always have a power-packed panel to take up all your queries. Thank you all for watching, and thank you, gentlemen, for joining us on this show. Remember, you can always send your feedback to us on this show, We Mean Business at ndtv.com. That's the email ID. The phone number's there on your screen, or you can send in your reaction to me. You can tweet me at shwetark@ndtv. Thanks for watching. Goodbye, and we'll be back tomorrow with another burning issue on We Mean Business.